Robinhood is the largest stock trading app of all time with over 13 million users, but they may well be screwing over all of them by selling their trades in dark pools. These are semi-secret, shadowy exchanges that operate alongside public exchanges like the New York Stock Exchange, but with a much lower level of transparency. Hey everyone, and welcome to FinTech. And in this video, I'm going to be talking about why Robinhood sells your trades in dark pools, why high-frequency traders are paying money for Robinhood users' trades, and finally, how all of this connects to Robinhood's current $65 million federal lawsuit. So hit the like button if you want, and let's start by talking about dark pools. A dark pool is essentially a stock exchange, only unlike public stock exchanges like the New York Stock Exchange, they are private and can be run by brokers, bankers, or really anyone who wants to start one. The purpose of dark pools is primarily to help institutional investors, those are investors like hedge funds or pensions that have millions or even billions of dollars in assets that they need to trade, to help them sell and buy stock without affecting the price of the underlying assets. If you think about it, let's say a large bank has two clients, one who wants to sell $100 million in Apple stock and another who wants to buy $100 million worth of Apple stock. Well, if one client tries to sell all of that stock all at once on a public exchange, it's going to drive the price of the stock lower and they're going to get less for their money than they could have otherwise. Similarly, if a client tries to buy that much stock all at once, it's going to push the price higher and they're going to pay more than they would want to. If, however, they could trade that money in a dark pool, the first client could sell $100 million at an established price, and the other client could buy $100 million worth of stock at the same price, and they wouldn't have to worry about driving the market price up or down. This is hugely beneficial for these large institutional investors like hedge funds and pensions that have that kind of money to move the market. Okay, you might say, but what does that have to do with Robinhood? Most users on the Robinhood app don't have hundreds of millions of dollars invested in the market. Well, that's true, and yet Robinhood still executes its trades in a dark pool. Well, on the surface, there isn't really anything wrong with trading your stocks in a dark pool, assuming you can trust whoever is running the dark pool to make sure that you, as a small investor, are always getting the best price possible for your stock, either in buying it or selling it. In reality, though, dark pools lack the same transparency and oversight that public exchanges have, which makes it really hard to guarantee that smaller investors are getting the best price of their stocks. It's really easy to take advantage of these smaller investors, especially when the majority of them probably don't even realize that their trades are being executed in a private market. Now, you may have heard recently that Robinhood was recently implicated in a $75 million federal lawsuit, and that's following up on a previous lawsuit with the SEC. So are dark pools the reason that Robinhood is getting sued? Actually, no. As shady as dark pools may sound, they're just the tip of the iceberg when it comes to Robinhood. The much bigger issue that Robinhood is facing now is a suit over the fact that they failed to tell users that their orders, the actual trades that you make to either buy or sell a stock, were being sold to high-frequency traders. High-frequency traders are a group of traders that use high-speed computers and networks which try to get information on stock trades before anybody else. They can then use this information to effectively forecast where the stock price is going to go in the future. And by the future, I mean a couple milliseconds in the future. These traders might buy a stock at $99 and then sell it 1 millisecond later at $100, making a $1 profit in 1/1000th of a second. They can do this simply by being aware that somebody else is about to buy the stock, which will drive the price upward. So in order to understand what these high-frequency traders want from Robinhood users' data, we need to define one more term: order flow. Order flow is the flow of stock trades into and out of a stock exchange. By Robinhood selling their users' order flow to high-frequency traders, those traders know what stock purchases and sales are going to be made before anybody else in the market does. Now, while most firms say that they only use this information to get general ideas of what the stock market is going to do and make a few cents off of trades here and there, there is absolutely the potential for abuse. The most obvious would be a practice known as front running. Let's say that a high-frequency trader sees a large order for Tesla shares incoming, which are going to drive up the price of Tesla by $1. That trader could buy shares of Tesla at their current price, wait for the price to be pushed up $1, and then sell for an immediate profit. By buying the stock before that large order could be placed, that stock trader is effectively taking some of the value that would have gone to that large order and keeping it for himself. Now, we're not talking huge amounts of money here. We're talking about a couple dollars per trade. But when you have 13 million users on Robinhood Robinhood who are all sending their data through these high-frequency trading firms, that adds up to a lot of money. Basically, every trade you make, there is a more sophisticated investor out there who is taking a percentage of your profit. To show you how big of a business this really is, there is one high-frequency trading firm based here in Chicago called Citadel, which made over $3.84 billion in revenue in just the first 6 months of 2020. The fact that Robinhood sells to high-frequency traders really shouldn't be all that surprising. After all, back in 2013, Robinhood was founded by Vladimir Tenev and Baiju Bhatt, who had previously built high-frequency trading platforms for banks in New York City. Now, it's not clear exactly how much money Robinhood is making from this as well as its other revenue sources, because Robinhood is notoriously tight-lipped about where they get their money. We do know from some anonymous sources in a Bloomberg report that back in 2018, 40% of Robinhood's revenue was coming from them selling their trades to high-frequency traders. The remaining 60% of their earnings then came from selling their Robinhood Gold subscriptions, as well as from making interest on the money that people left sitting in their accounts uninvested. Back in 2019, their revenue from selling order flow was estimated to be between $150 and $250 million. But if we look at some more recent data, it appears that a larger and larger portion of Robinhood's revenue is coming from selling their order flow. By looking at an SEC filing from the first quarter of 2020, we know that Robinhood pulled in around $100 million from selling their order flow in just the first 3 months of 2020. Now, based on the fact that Robinhood did not double their number of users, so we can assume that their revenue from Robinhood Gold, as well as the interest they're making from people leaving money in their account, this seems to indicate that Robinhood now makes the majority of their income by selling their users' trades to high-frequency traders. But does that mean you should stop using Robinhood? Well, unfortunately, there may not really be many better options out there. Charles Schwab, E-Trade, TD Ameritrade, all of these brokerages make money by selling their customers' trades in their order flow, meaning that switching to another brokerage or a different platform may not be all that helpful. Unfortunately, this is just one of those situations where as a smaller retail investor, you don't have the same power that larger financial institutions do to go out and find other services. In fact, the only platform that I could find that did not sell your trading order flow was Interactive Brokers. And even then, it was only if you use their pro service. If you try to use their free service, they do still sell your trades. But while this can be a troubling practice that can lead to abuse, in fact, the former SEC Commissioner Mary Jo White has warned that this practice can create conflicts of interest. In fact, in 2019, Robinhood was fined for not making sure that their users were always getting the best stock price available. That being said, payment for order flow is not always necessarily a bad thing for small investors. In the vast majority of cases, you will still get the same stock price that you would on an open exchange. In reality, a lot of the time, it's the larger hedge funds and institutional investors who are losing money because of this practice. Basically, those high-frequency traders can use the data from smaller investors' trades to extract value from larger investors when they need to sell large tranches of stock. If you want more information on this practice, there's this really interesting book by Michael Lewis, who is the author of The Big Short and Moneyball, which explains this in detail. That book is called Flash Boys, and it talks all about dark pools, high-frequency traders, and payment for order flow. I'll put a link to where you can get it on Amazon in the description, and if you'd rather listen to an audio version of the book, I'll put a link to 40% off Audible for your first 4 months. With that said, I hope you enjoyed this video. If you did, make sure to leave a like, and if you don't want to miss out on any future videos, make sure to both subscribe and hit the notification bell. I'll see you next time.